Hi, I'm Wes Fulford, CEO of Bitfarms. As per my introduction, I'm here to talk about our business in this crypto ecosystem. We're a large-scale, 36-megawatt Bitcoin crypto miner. We're vertically integrated. We're all based in Quebec, 5 facilities sort of southeast of Montreal, between half an hour and 2-hour drive from Montreal. And we benefit from low-cost hydroelectricity at a price of 4 cents a kilowatt hour. So today I wanted to sort of impart our views on what's happening in this ecosystem, specifically with price and difficulty, and how that relates to financial markets, what's going to spur the next wave of financial adoption here, and most importantly, where things are headed. The prompter just died on me. So the business of cryptocurrency mining. Shown here is an overview of the sort of 5 coins we've focused on historically at Bitfarms. Bitcoin on the left is our currency of choice. It's the dominant cryptocurrency, 52% of global cryptocurrencies by market cap. You've got an overview of the reward and the block system and the rewards per block. Today, the pool we're chasing is roughly $10.8 million a day worth of cryptocurrencies, and your share of that prize pool is directly a function of your hash power versus network hash power. When we look at the mining business, it's really about a set of external factors that we can't control and a set of internal factors that we can control. On the external side, it's really about, obviously, pricing, which directly governs or impacts difficulty or network hash rates. And 2, what's happening with the hardware landscape, ASIC technology and inventories in production. On the internal side, these are the elements of the business that we can control. You've got, first of all, industrial scale, professional engineering, emphasis on thermodynamics, where you're plugged in terms of the cost of power, and how you're using that power in terms of power maximizing your hash rate output and not relying on heavy air conditioning to cool your facilities. Your performance and monitoring software to target underperforming hardware and your ability to repair that hardware in-house. At Bitfarms, we've been mining at an industrial scale for about 4 years, which is, light years ahead of most of our public market comparables. Moving on, so looking at price difficulty, this is available through many different public websites. Can somebody quickly have a look at the teleprompter again so I can see what I'm presenting? Here we go. The blue line shown on the bottom is BTC prices. So what we saw in 2017 was really this sort of parabolic growth, this fear of missing out trade, irrational exuberance amongst primarily retail investors as people piled in, drove the price up to an intraday high late December 2017 of $20,000. Since then, pricing has pulled back 85%, sitting today at around $38.50. What this period of growth in BTC pricing led to was these outsized returns in the mining market. There was a point in December 2017, where you're generating about $4 a terahash on your miners, which is certainly something we haven't experienced historically. This led to a massive inflow of capital from both public market investors as well as private capital, buying hardware wherever they could get it, paying ridiculous prices, $3,000, $3,500 a miner from third-party distributors, and then setting out to find a place to plug it in a jurisdiction where there was low-cost power, and ultimately trying to build out teams to manage operations in-house without having to rely upon third-party master service agreements. When we look at this chart, obviously there was a lag between difficulty growth and BTC price growth. It took roughly 7 or 8 months for all that capital to find a home, to be plugged in and start hashing and to actually find its way online. We saw things sort of peak out at just above 6 terahash in October of 2018. Sorry, 7 terahash. And then things flatlined. In October, it was October 18th, 2018, we saw a 3.65% pullback in difficulty. This is the second difficulty drop of 2018. And since then, mainly driven by a drop in Bitcoin from 6,300 to 3,500, in the start of November, you saw difficulty fall sort of lockstep. And this graph was certainly a lot more compelling when I presented it 2 months ago. But you saw this perfect positive one correlation between price and difficulty. And what that suggests to us, and as we look at difficulty and price over the last 3 months in particular, there's been a lot of stability in the network. We really do believe that we're approaching this equilibrium where the marginal miner has been forced to unplug, and really the only participants remaining at this point is the industrial scale, low cost, vertically integrated participant. Analyzing hash rates over the last month, one could look at this chart and say, what does this mean, right? I challenge you to draw some conclusions from this hash rate chart, but when we look at this, it's really looking at sort of where does the base load sit right now. There's roughly 4 to 4.2 exahash worth of participation at the industrial scale, low cost miners in this universe. And then you're seeing this ebb and flow, these peaks and troughs, which range, I think the largest fluctuation we've seen was in February 17th of 2019. We saw a 20 exahash move, which is quite astounding when you actually think about it. That's about 1.5 gigawatts of power coming on and offline in a 24-hour period. What we can conclude from looking at hash rates is really it just supports our equilibrium argument that when in a period where there's a small drop in crypto pricing, BTC pricing, while we're waiting for the block or the difficulty to adjust following the 2016 block, there are marginal miners to the magnitude of 20 or 30% of the network, which are literally forced to unplug and are monitoring conditions on a daily, if not hourly basis. You could also suggest that in geographic regions where they're experiencing significant swings in peak and off-peak pricing, there's miners that are forced to unplug every 12 hours. When we look at the mining economics and try and predict where things are headed, we really focus on, first and foremost, capital, people's willingness to invest, but really the hardware landscape is going to dictate where we're headed. Right here is we're showing over the last 5 years the the revenue per terahash charted against the leading hardware manufacturers, rumored to do 65% of hardware sales in 2017. Bitmain, the release of their new generation mining equipment. So the S5 in 2014, the S7 in 15, the S9 in 16, and as of November 8th of 2018, the S15. And what you're seeing from generation to generation is roughly a tripling of operational efficiency. The S7 was a 1.3 kilowatt miner delivering 4.7 terahash. The S9's a 1.4 kilowatt miner delivering 13.5 terahash. What's interesting about the new generation equipment is the S15 is a 28 terahash miner drawing 1.6 kilowatts of power. It's a 59% efficiency bump over the S9. In the period of December or Q4 2017, you saw this all-time high, these outsized mining economic returns, which spurred this deployment of capital, people aggressively trying to deploy hardware into infrastructure build-outs they had not secured yet. But since then, we've seen relative stability over the last 3 or 4 months at somewhere in the range of 15 to 20 cents a terahash in terms of revenue per miner. Where things are headed, if you're to, as a public company, so we're public listed in Israel, we spend a lot of time forecasting out our cash flows, our operations, to make prudent capital deployment decisions. We'd like to stress test our model and try and figure out what the impact of the hardware landscape is going to have on actual network difficulties and hash rates. If you're to make some broad assumptions and say, everybody today with 40, 42 terahash of computing power on the network is mining with an S9. You've got roughly 3.5 million miners participating in this network. If you're to swap out every single one of those miners with an S15 and agree with our argument that the markets are approaching this equilibrium, you could naturally imply there's going to be about a 60% growth, assuming people have capital deploying to the new hardware and assuming the manufacturers can actually hit the production runs required to deliver that. When we look at the hardware landscape, there was a few interesting points from 2018. In May, June, and September, you saw 3 of the leading hardware manufacturers file for Hong Kong IPOs, Canaan, eBang, and Bitmain. Since then, Canaan has pulled their listing as rumored to be looking at a New York listing. In my opinion, that'll never happen. You have eBang that has refiled a lapsed application in December with significant disclosure about operating losses and reduced profitability. And Bitmain's application is set to expire later this month. Bitmain at one point, I believe, was rumored to be trying to raise over $1 billion US worth of capital at a $14 billion valuation. And what we sort of dissect from this public markets overtures is the fact that when you think about manufacturing hardware and trying to compete in this business on a global scale in a very competitive marketplace of industrial scale producers, having the capital required to do significant commercial production runs, to be able to fund the inventory working capital is paramount. A number of these manufacturers are overdrawn on credit facilities provided by some of the chip foundries, and we really do think, and this is also based on active discussions with CEOs, head of sales at all these companies, that there really will be inventory constraints, production constraints, and when you compound that with the lack of capital and future deployment, we really don't think the sort of growth in network hash rates is going to be significant over the near term. I mentioned the external and internal factors in our business. On the internal side, there's various elements that we can control. First and foremost, where you're operating. All of our operations are in Quebec. They're powered by hydroelectricity at a cost of 4 cents a kilowatt hour. This, when you look at, and I'll talk about product or profitability in a couple of slides, is significant, right? There's marginal players out there plugged into regions right now where they can't generate positive mining margins at 6.5 cents. Industrial scale build-outs. All of our operations, all of our build-outs are designed in-house with an engineer with an emphasis on thermodynamics. We use negative pressure systems, don't rely on air conditioning to create ideal operating conditions. In March of 2018, we also constructed a custom microelectronics repair facility where we repair hardware identified by our proprietary performance and monitor system in-house, and we don't need to rely on third-party warranty programs provided by the manufacturers themselves, when often there's a 2 to 3 month backlog to get your miners back. And then, most importantly, I think, in our vertical integration efforts is an acquisition we made in January of 2018, which is the purchase of an electrical contractor in rural Quebec called Volta Electric. So we actually have 30 electricians in-house. They have a third-party book of business that they pay for themselves when we don't need them. But they allow us to do rapid build-outs, paying employee costs, not commercial costs for all of our leasehold improvements, and the ability to negotiate sort of preferred pricing with some of the key infrastructure suppliers versus the commercial rates our peers are paying. When you think about operational profitability, it's no secret that power costs are your single biggest operational expense. The second biggest factor in profitability is how you're using that power. And we like to look at and compare our business to the traditional data centers globally. We found a report, and I know this is somewhat dated. I think it's a 2008 report, but it's an analysis of the power consumption, or more specifically, the power usage efficiency how much of the actual power is going into servers for global data centers. Best in class are only delivering about 83% of their power into servers, 17% is going into cooling. The average is around 50. We're a publicly traded company, and in the first half of 2018, we reported our PUE ratio of 94%. Here's a picture of one of our build-outs. This is a 10-megawatt facility in Saint-Hyacinthe, Quebec. This was built in December of 2017. It houses about 6,500 S9s right now. What you'll see in the picture is, or notice in the picture, is the cable management. On the right side of the screen, you'll see our custom filtration systems to keep the Quebec elements out. Our mining racks on the left side of the photo. I'll show you better pictures of that later on. But what you won't see is air conditioning. So our design is actually very simple, and I'm assuming most of you have figured this out in the crowd. It's really about partitioning off one half of the facility from the other, exhausting out more air than your miners produce, and creating this pressure gap on your intake side to draw in our case, cold, cool, humidity-free Quebec air. Shown here is our fifth facility. This was constructed, or completed construction in August of 2018. We brought it online and started hashing in November, early December of 2018. This is a 10-megawatt build-out in the town of Magog. It's 2 hours southeast of Montreal. What's noteworthy in this photo, or why I wanted to highlight this, is this build-out was completed start to finish in a matter of 8 weeks. This is one of the keys to owning your own electricians, having them on staff, and utilizing their expertise in this sector, constructing all of our facilities to date. We don't publicly announce our build-out costs, but I can assure you, having those electricians on staff and the ability to negotiate hardware or infrastructure pricing from the distributors directly at a discount to the commercial rates paid by our peers, our delivery cost on a megawatt basis is significantly lower than some of the metrics you've seen in the public markets. Here's a photo of Saint-Hyacinthe again. This is, again, our fourth facility. One of our technicians is walking around with our performance and monitoring software. You'll see the tightly packed and stacked miners, forcing the airflow through the miners themselves versus gaps in our racking, key to our 94% PUE ratio, the cable management. We've developed a custom SKU system based on the manufacturer barcodes so we can identify exactly where a miner's racked. Our performance and monitoring software was designed by one of our founders with the expertise in high-frequency web traffic. So we're actually polling our miners at the chip level, 16,500 miners across all of our farms in 10-second interviews with live diagnostics on heat output and operational hash power. So when miners are identified as underperforming or problematic, they're unplugged to cool them down. If they need repair and servicing, they're de-racked, sent to our microelectronics repair facility in St. Jean and back online in 24 hours. So between power cost, power usage efficiency, and hardware uptime, these are the three biggest components of maintaining operational profitability in this environment in particular. In Quebec, we have 162.5 megawatts of contracted power. Our last power contract was signed in March 2018, in advance of some of the political noise in the province that you may or may not be aware of. The focus of our 2019 build-out will be Sherbrooke. This is a 98-megawatt power contract, 2 hours southeast of Montreal. Here we'll be plugging in new-gen miners. We'll start our build-out on a 30-megawatt phase one at this facility later this month. When we look at the next wave of adoption, and I know there's been various presenters that have come up here to share their views on what's going to be the next driving force in this marketplace. First and foremost, on the public side, which traditionally would be where most peers go to source capital to continue to build out in traditional industry, the Canadian marketplace has actually been quite active. There's 12 plus listed companies between the CSE and the TSX in Canada. There's been $625 million capital raised over the last 14, 15 months, with participation from 25 institutional investors and 10 broker-dealers. The next wave of adoption, without question, from our perspective in the near term, is going to be financial market legitimization. There's a couple of interesting graphs here depicted on the top chart. I believe there's 239 new crypto hedge funds created in 2018, which is a growth over 224 in 2017. What's noteworthy on the graph below is those funds are now managing $10.2 billion US dollars worth of cryptocurrency, which, when I think about sort of overarching market dynamics, the fact that BTC in particular has pulled back 80-85% in the last 14 months, I would expect that number to decline. So the fact that it's on the rise means these funds are managing more money and more capital continues to be deployed into this sector. In terms of market participants, on the right side at the top there, a recent announcement by Morgan Creek, a group out of the US. They've raised a $40 million blockchain opportunities fund, and their two largest investors were two public pension funds. We saw a similar announcement from Yale Endowment. You've got traditional large cap conservative capital starting to find a home in this sector, looking for hard asset diversification. On January 30th, Van Eck partnered with CBOE to refile their ETF application. If any of you read comments from the SEC back in August of 2018, you may have seen that the two biggest sort of red flags they highlighted with the original application were custody and price transparency. There's been two significant announcements as of late on both of those fronts. One, the ICE, which is the publicly traded owner of the New York Stock Exchange and 10 other major global exchanges, has raised $182 million in capital with investors like the Boston Consulting Group and Microsoft Ventures to launch Bakkt, a regulated, transparent, liquid cryptocurrency exchange. In addition, Fidelity Digital Assets has now gone live with an enterprise-grade Bitcoin or digital currency custody solution, fully insured. So basically the two biggest issues highlighted by the SEC, there's market participants working on solutions to that, which will help spur financial adoption going forward. When you look at the reason why these institutions continue to deploy capital into the sector, you have to look at the history of money. And there's an interesting book, I'm not sure if you've read it. If you haven't, go out and buy it. It's called The Bitcoin Standard. It was published in November of 2018 by a gentleman named Safidien Amos. And he really breaks down sort of the value proposition of Bitcoin or cryptocurrency in terms of its properties as a medium of exchange. And the three biggest components of that being salability, the willingness of a participant to accept that in a transaction, the liquidity, transferability that supports. Two, being store of value, and three, unit of account. We all know the sort of pushbacks or scalability issues tied to Bitcoin right now. Salability isn't what's driving. It's not a functional currency yet. There's obviously applications being worked on to improve that, but it's not there. We hope it will be there soon. Really what the driving force behind financial market adoption at this point is its properties as a store of value. And obviously there's been lots of similarities drawn between crypto, Bitcoin in particular, and gold. And when you look at Bitcoin as a store of value, you have to analyze the stock to flow ratio. Stock being the current supply outstanding, flow being the new supply being created on an annual basis. And when you think about Bitcoin, much similar to the properties of gold, there's an incredible amount of money that goes into producing new coins or a new ounce of gold. And the growth in annual supply, in particular with Bitcoin, is formulaic. It's very predictable. So the chart on the right is interesting. We found, I think it's produced, actually I don't remember who we sourced this from, But over the next 25 years, when you look at Bitcoin, the annual supply increase is only anticipated, and this is, again, formulaic coded in the protocol, only supposed to increase 27%. That compares to gold at 52%. You look at some of the leading global currencies, the US dollar, the euro, the GDP, the Great Britain pound, you're anywhere between 270% and 430% anticipated growth in the supply of that currency. Growth in supply, i.e. flow, leads to deflation, destruction of purchasing power. And when you compare that to Bitcoin, we really do believe that Bitcoin's a deflationary asset class, and in traditional financial markets, portfolio management, this is really what's driving adoption by the financial markets. In the medium term, we look at the millennial population. What's quite astounding is there's a report produced by Edelman in October of 2018 looking at the millennial population globally. There's an anticipated $24 trillion wealth transfer between aging baby boomers and their millennial kin. That's 15 times the GDP of Canada globally, annually. Of this peer group, of this millennial population, 61% use peer-to-peer payment apps, PayPal. 25% of them use or hold cryptocurrency, and 74% of them believe that blockchain can make the global financial system more secure. What's important when these investors look at managing their investment portfolio or their decisions, environmental, social, and governance is certainly a focus, but most importantly, 77% of affluent millennials, the vast majority, believe that it's just a matter of time before the bad behavior of the financial industry leads to another global financial crisis. Compare that to 58% of affluent Gen Xers and 58% of non-affluent millennials. Bitcoin challenges and developments, certainly scalability, which I've talked about, custody being addressed by groups like Fidelity Digital Assets, and volatility being addressed by groups like BACT. Colin just spoke about proof of work protocols. There's this ongoing debate about what makes more sense long-term, proof of work versus proof of stake. As a publicly traded cryptocurrency company, blockchain infrastructure company, we have some firm views about proof of work versus proof of stake. Proof of stake really doesn't make sense as a publicly traded company as we look to fund our operational growth and expansion. And this slide, typically we would lead with a energy analysis on how Bitcoin compares to traditional financial markets. The chart on the right is an overview of a typical credit card transaction. Visa, MasterCard at the top. What's most important is sitting on either side of that transaction is an issuing and acquiring bank, all providing the authorization, clearing, and settlement for Visa transactions. When you think about it globally, and Colin alluded to the current Bitcoin network drawing about 50 terawatt hours globally of power at current network hash rates. When you compare that to traditional financial markets and payment systems, and think about the offices, the branches, the ATMs, the fuel, powering cars for all those employees to drive to the offices, the paper feeding photocopiers and client statements, it really does pale in comparison to Bitcoin network's global impact, environmental impact to some of the lethargic financial systems that exist today. Newsworthy announcements. Obviously, you guys are all aware of these headlines. What's most compelling to me when you look at some of the media of 2018 is JP Morgan. You have Jamie Dimon, CEO of JP Morgan, who's been certainly the most adversary, the largest adversary in public media regarding Bitcoin and what it represents, and his disbelief in its place in our world. Yet this month, earlier in February, he actually launched the JPM coin. It's a digital coin allowing instantaneous transfer of payments between institutional accounts. Groups like Samsung, I think there was a comment earlier, I actually just picked up the new Galaxy over the weekend. I'm disappointed to say that it does not come preloaded with a crypto wallet, but it does have a blockchain key storage application. So I'm assuming I'll get an update over the coming weeks. Facebook, Telegram, Signal, three of the largest tech companies in the world, or instant messaging companies in the world, all launching cryptocurrency payment systems within their applications. So some major developments in addition to financial market adoption that are going to continue to drive this marketplace. We're extremely encouraged about where things are headed. And right now, in terms of the hardware pricing environment, the lack of capital flowing into the sector, we believe that it's an excellent time to continue to build and become a bigger market participant in the Bitcoin blockchain in particular. Some highlights on our business. Again, I alluded to, we've got 36 megawatts, 162 megawatt portfolio, all in Quebec, powered by 100% green energy, hydroelectric power. We're paying 4 cents a kilowatt hour. That's published as a capital markets listed company. We have an in-house dedicated operational team, so we don't rely on third-party master services agreements to manage our operations. And our emphasis certainly is just on leveraging our vertical integration going forward. And I'll leave you with things we're doing outside of the crypto world. We recently partnered with ETS, a technical school in Montreal, working on some interesting blockchain infrastructure applications. First project being a blood donation system using smart contracts. That's my last slide, so I believe I'm out of time, but if there's any questions, I'll be around, or I can answer a few now.
So, just given the massive size of your footprint, it is very impressive. What kind of digital security measures are you taking to ensure your clients' investments?
We're a public, like our clients as in our shareholders?
No, like as in the rigs you're mining. How do you make sure that effectively somebody like me doesn't go and compromise your monitoring or your mining software?
Our two of our founders are we've got 4 founders. 2 are in Argentina and 2 are in Quebec. One is a expert in industrial scale data centers for the last 20 years, and one is a programmer. Specializes in high frequency web traffic. We host all of our own platforms. We host our website. We do participate in a public mining pool at this point, being Antpool, but we do have a system we launched. We actually launched our own pool that we host ourselves and analyze our hash rates and daily production rewards on a regular basis every day.
Do you guys run full nodes as well at the scale you work at?
No. The answer is yes. So in November 2018, we actually filed a preliminary prospectus with the OSC and are currently underway on a process to see the company migrate to North America. Are we able to raise any capital? Sorry? Borrowing capital? As a former banker, I'm keenly aware of the fact that traditional capital sources have dried up as of late. There was this huge flood of capital in Q4 2018 or 17 and Q1 2018. Again, I alluded to $625 million being raised in Canada and deployed by miners alone. Right now, I think the industry has been plagued by bad actors, overspending on hardware, promising to deliver business plans that they failed to deliver. There's many of our peers actually ended up buying hardware at $3,000, $3,500 per S9, ended up hosting them in facilities because they couldn't find or build the expertise in-house to go deploy the infrastructure themselves. So as we look to the next phase of growth for Bitfarms and capitalizing our operational expansion, certainly the priority is looking at alternatives to traditional capital markets. But I believe it's really just a matter of time before the next window opens. Yep.
Has the pushback in Hydro Quebec affected your business at all?
We signed our last major power contract in March of 2018, which was 2 or 3 months before some of this noise started in the province with 15-cent rates and 500 megawatts being allocated to new applicants or new entrants in the province. This process unfolded on the back of there being rumored to be 18,000 megawatts of applications for power within the province, in a province that produces about 35,000 megawatts of power. We believe a lot of that was from some of our peers sitting on $5 million worth of capital looking for gigawatt power contracts that would have never been able to deliver. So a lot of it was noise, but we do feel that will be treated or grandfathered in based on the fact that all of our contracts were executed long before this process started. And to our knowledge, we were one of the only groups that were invited to participate in terms of expert testimony as part of the RIGI's process to evaluate how to treat this sector going forward. No. Yes. I've been criticized for being too hard on some of my peers in the public marketplace, but Hut 8, you can't ignore the fact that they've built size and scale very quickly. They deployed $120 million of public capital into their build-outs, plus a 40% vendor take-back in the form of equity for Bitfury and every block box they've bought. They're running 784 petahash using 95 megawatts of power right now, which translates into about 8.2 petahash per megawatt. You all can do the math. It's readily available. I mean, long term, I don't know how sustainable that operation is going to be. Great. Thank you.